and The Money Show, and their wonderful contributors that are joining us on stream. Mike Larson was our lead here from The Money Show. He'll circle around the room, give everybody their intros. Excited to be here. A lot happening in this market. We are in a crazy sell-off today, especially after Trump said that he expected stocks to go lower. Thanks, Trump. Appreciate that. And so there's a lot to talk about. So, Mike, I'll turn it over to you to get started.
Yeah, absolutely. I found something that was green on my screen, and then I looked closely, and it was oil. So there we are. Welcome to the Joint Money Show, Wolf Financial Stock Market live stream. We've got a really great panel of experts here that are going to be talking about this wild market environment and share their best strategies, best plays for navigating it. A lot to cover: war, inflation, sector rotation. I mean, we've seen a month where there's been a simultaneous sell-off in stocks, bonds, gold, kind of what smells or smacks of delevering. So, a wild environment, and I want to get right to it. But I do first want to introduce each of the panelists you're going to be hearing from. I'm also going to tell you about an opportunity where you can learn from them live and in person very soon in April. Everybody's going to kind of wave to the camera as I introduce them. We first have Carley Garner, Senior Commodity Market Strategist and Broker at Carley Trading. She's going to be talking about things like crude oil and gold volatility and tying it all together, trading strategies. We've got Craig O'Sullivan, a blockchain and capital markets exec. He is going to be talking about AI and crypto strategies at the event that I'll get to in a moment. So thanks for joining, Craig. We have Steve Suminski, options instructor at Trading Academy. He is going to be talking about things like covered calls on steroids and, again, joining the trading strategies panel. So we've got Steve on options coverage. And we have Darren Wagner, who's joining us from the farthest away, as far as I know, for this panel. He's coming to us from Thailand. He's the founder and head portfolio manager at Morpheus Trading Group. And he's going to be talking about how smart traders can break their rules and share a position sizing strategy that solves the discipline problem. Finally, Javier Paz, founder of Rigor Rank. He's going to be talking a little bit about AI-assisted crypto due diligence and also some AI and crypto strategies. So again, that's the panel we have here. And of course, always happy to work with Gav from Wolf Financial. We've worked with him on a number of Money Show events, podcasts, X segments, you name it. So thanks to you as well. And before I jump into the discussion, just as I mentioned, we're going to be hosting our 2026 Money Show Masters Symposium in Hollywood, Florida. It's right around the corner, April 9th to 11th at the gorgeous Oceanfront Diplomat Beach Resort. And frankly, because we've seen so much demand for guidance in this market, we added a pre-show event on Wednesday, April 8th. It's entirely free. Gav will pop the link up there. You can get some information on what the pre-show is going to cover on April 8th. You can get some information about the full show, April 9th to 11th. We're going to be covering AI. We're going to be covering tech. We're going to be covering crypto and trading strategies. So again, take a look at that link. If you're interested in joining us, we're in Hollywood, Florida. So we got that preamble out of the way. Let's dive right into this markets discussion. I've got to ask, trading in this kind of crazy volatility, how do you navigate it as a trader? What are some of the things you're watching? And Carley, I want to start with you because you've had a lot to say about oil and gold at some of our events. And clearly those commodities markets are really what's driving the bus here.
You're right. Regardless of what you're trading, stocks, bonds, currencies, you're actually just trading crude oil. Crude oil is kind of driving the ship, and I think it's going to be that way for the foreseeable future. Volatility is intense. I'd say in this type of environment, less is more. This is not the time to be swinging for the fence, in my opinion. I think this is the time to preserve capital and try to take it easy because it's going to be a rough ride for the next couple of months, in my opinion. That said, we have to make sure we don't get caught up in all the headlines. We should remember from 2022 when Russia invaded Ukraine, there were a lot of wild predictions, crude oil 200, so on and so forth. And as time went on, we learned that all the things that made crude oil go to 130 during that time worked itself out. And so I think we'll probably be in this similar situation this time around. I'm not saying it's going to happen overnight and it's going to be, like I said, rocky, but in the big picture, I think this is probably just a temporary blip. Higher crude oil prices tend to be deflationary when we're in an environment in which growth is questionable. And so I have a feeling that there could be a rug pull on some of the risk assets, and particularly crude oil as we get down the line and here in a couple of months.
Got it. Thanks for that, Carley. Steve, I haven't had a chance to get you on one of these before, so I want to pivot to you and maybe just briefly talk about what you're seeing in this market. And as an options-focused guy, how do you handle setups, trade volatility in this kind of market?
One of the awesome things about being an options trader is you just can be ready for anything. And so I've been going in either direction. And so I've got some things that kind of help me stay centered. And you can diversify through time. You can do some real short-term stuff, not necessarily zero DTE, but just some mean reversion things, puts and calls. And then also horizontal spreads are the two main topics I'm going to be covering. I actually have a couple of slides to something I can show you here in the way of, I'm not sure if I'm sharing my screen or not. Yeah, let me share my entire screen and go here, share that. And then there's some things I look at that are go-tos to help me kind of make sense of things. And one of the first things is the big picture is kind of the seasonality. And if you look at the midterm election year, that's going to, it doesn't look all that great. And midterm election years in the 4-year cycle are the worst. Now, we've had 3 years in a row of about twice as good as what we normally get. And so I haven't been expecting much out of this market anyway, right? And then the fear and greed index is now pushing extreme fear in the short run. The 6-month outlook is looking much more bearish than usual. Normally 31%, now 49%. And so things are, I don't think, looking real great, and that's fine. You just play it the other way. One of my indicators that is kind of a groundswell indicator is a moving average cross indicator. And this is much faster reacting than the usual golden cross and death cross, which are really big lagging indicators. And so I use something a little bit more dynamic, but had you used what I'm using, you would have seen that things were looking bad around March 5th. And that's when this indicator, this moving average cross indicator, it's 20-30, it's 10-20-30, where the 20 and 30 are EMAs. And so that kind of gives me sort of a heads up that maybe I want to start shading that way. Another thing that my mentor taught me is this thing called the purple predictor, the unbalanced volume. And so that's the purple jagged line. And you can see that it's not very supportive of the SPY right here. If there's any good news at all, it's starting to kind of chop a little bit. So it could go, we're at the low end of the range. Anything could happen here. And so I kind of use that as sort of a short-term indicator as well. The mean reversion trades that I'm talking about, here's an example. I bought a put yesterday on Tesla, and it's part of some rule-based strategy that I'm going to be sharing at the show. And it's one of the simplest, most time-tested strategies, one of my favorites that I've been using for decades, and my mentor used it for decades before me, before he taught it to me. And so 21% gain in one day, not too bad. And then the other thing I'll be showing will be horizontal spreads. So you can diversify through time, and you can do longer term, shorter terms. You can do leaps. You can do what I call guerrilla calendar spreads, which guerrilla, not the animal, but guerrilla like a military tactic where you get in quickly and get out quickly and just try to sell some nowadays with these Monday, Wednesday, Friday expiries and then daily expiries on the overall indexes. You can do a lot in really short time frames, selling premium. And you caught me at a good time, because it just so happens I closed out a winner today. That's the green one. And then all the others are positive. All these other trades are positive. I don't have a single loser in the portfolio. Plus, I'm up year to date on all the realized. So thanks for having me on today. That was really good timing. I appreciate that. And I think that's I'm going to leave it there and let somebody else have a chance to talk. But
well, happy to oblige. I like when we get the timing right. So when you'll turn off the screen sharing there, and I'll go to you, Darren. And thank you for joining us and at quite a late hour there for you. When you and I were talking in Vegas at our recent event, it was all about how investors can kind of focus on what's actually happening in front of them versus what they think should happen. I know you've got a catchier slogan for that, but I want to know why is that advice so important right now? What does somebody do to kind of keep their emotions in check when you have a market like this that just, again, it's ugly, Yeah,
that's a great question, Mike. I think that one of the most important things is to keep proper position sizing. We focus on trading psychology, and really the four most dangerous emotions in the market: fear, greed, hope, and regret. Typically, those are amplified when people are taking too much risk, right? So, for example, if you're just buying however much your account allows for any one trade, then it's going to be very difficult to follow your plan, especially if the market starts moving against you. So I would say the first thing is make sure that you have a fixed position size. Our position size is fixed to a percentage of the portfolio on every single trade. So it doesn't really matter whether we're in an uptrend or downtrend. If we stop out, we lose, 1% typically of the account. So I think that really removes a lot of the emotion and helps you to just kind of make it more systematic. I would say also that, before you go into a trade, obviously, I mean, it goes without saying, but sometimes, logic goes out the window when we get into a market like this. And obviously keep your stop in place, but I would definitely use physical stops. I mean, if you're the kind of person that normally in a bull market, you're using a mental stop, good luck with that right now, because it's especially with the market being very whipsaw from day to day. Well, until recently, until we broke down below support now. But I think that definitely fix your position size and make sure that you have each trade written out in advance so that you're not just winging it based upon whatever news there is for the day.
Got it. Thanks, Darren. Craig, I want to pivot to you and touch on crypto at this point here and some of the developments we're seeing in digital assets. I mean, you were on our panel last year in Miami, talked about some of the developments you saw back then. Can you talk a little bit about how the industry has changed, how trends have changed or have not in some respects about a year ago to now?
Well, clearly the biggest difference in the past year is the price. So clearly Bitcoin and the rest of the crypto markets have sold off dramatically since then. And that all started in early October when Bitcoin hit a cycle high of about 125,000, and now it's back below 70,000. Certainly Bitcoin has kind of been a leading indicator here of the downtrend in the broader markets. So it's generally ahead of the game, and that's partly due to the fact that it trades 24/7, 365, whereas the broader markets, they only trade really 5 days a week, but up until just the last year and change, markets were closing at 8 p.m. Eastern after trading hours. So now we've got them where obviously the broader indexes and the ETFs tied to those, as well as the mega cap stocks, you can trade those 24/5, so 24 hours a day for 5 days a week. But on weekends, Bitcoin is still king when it comes to reacting to weekend news, and obviously we've seen more of that recently with the war, right? So, but since the start of the war, Bitcoin and the crypto markets have held up relatively well compared to the broader markets and also gold. Right. So last year, gold, the precious metals, silver, they had their best year in decades.
Yeah.
And even at the start of this year. But they've all pulled back significantly. Gold's now in a bear market. It's 20% down from its all-time high just about a month and change ago. Silver is down almost 50%. But Bitcoin has held steady really since the onset of the war, which is going on almost 4 weeks now. So maybe it's because it obviously was hit early on,
yeah,
and most of the selling pressure has been alleviated. But there may be other factors associated with that. And obviously we've seen some developments here on the regulatory front. Just yesterday, for instance, with the stablecoin yield issue tied to the Clarity Act, there was actually some negative news developments related to that. So Circle, which is the only publicly traded stablecoin, has taken a pretty big hit here in the past day and change as a result of that. So that's down over 20% just in like 36 hours. But it all comes down to, are you a long-term investor or are you a short-term swing trader, right? So if you're a long-term investor, none of this stuff matters. All you're doing is just dollar cost averaging into your assets. And quite frankly, at this point, Bitcoin is a long-term investment. It's not something you trade anymore. It's just like the SPY or the QQQs or the diamonds, right? The major ETFs tied to the broader indices. But for swing trading, you're going to do that on your smaller cap stocks and obviously your speculative crypto tokens. And generally, when it comes to those, when you're crying, you're buying, and when you're yelling, you're selling, right? So just keep it simple with that.
Yeah,
If it
there you
moves
go.
up quickly, you got to take profits. All right. So
Yeah, no,
that's the most basic advice, and it's tried and true.
got it. Javier, I want to go to you. Thank you for that, Craig. Javier, tell me a little bit about what you're seeing in this market. And also, I know you're going to be talking about incorporating AI and AI tools essentially into your trading and so on, whether it's crypto or other assets. So I'd love to hear maybe your insights on, what you're seeing happen there and how the technology is evolving for people.
Sure. So big, in terms of the big picture, I would say that we have been waiting for a long time for a break in the correlation between crypto and equities. Risk assets diversification. But that has not really happened. There was in October a time when maybe you would hope that it could happen. It didn't. And now we're back in a way in which Bitcoin and the rest of the market is trading very much like a higher beta, to the S&P 500. So what that means is, for every unit of risk that you're taking in crypto, you're basically accepting, a bigger potential loss than what you would see in the S&P 500. And the S&P 500, the SPY, basically it's in my view is down for another 10-12% correction to test some resistance, dating back a couple of years. So with that in place, I think it's not a good omen for crypto unless it breaks out of on a different footing. Let's say, for example, a major country, not El Salvador, not Kazakhstan, but a major country were to say, we're going into crypto with our reserves or something like that, something dramatic like that. Unlikely, but it could happen, I guess. And that kind of announcement could break the psyche, if you will, the tight correlation between Bitcoin and the wider market. But short of that, I think, and no longer being able to rely on what the current administration is doing in the U.S., to be, even if it's pro-crypto, still, as the Clarity Act, shows, that the administration may or may not be able to get its way in terms of the type of legislation that comes out of Congress these days. So I think that what we are seeing is a period in which, the over the short term, if you can maybe buy a inverse Bitcoin ETF, that could be a good trade. If you if you're a short-term trader, that kind of high risk kind of possibility, it's something that you could do. But if you are rather more of a strategic buyer that wants to just bide your time until it's time to go, I think it could make sense to wait until the S&P has stabilized a bit, and then you should see a bigger upside by buying crypto than just by buying equities. So that's I think the scenario for now. In terms of AI being incorporating, I've been a capital markets researcher for 25 years. I worked for banks on the sell side. I also worked for an analyst firm for 8 years, analyzing the market for institutions. So typically trading and trading technology, trading regulations, business trends. And for the last 4 years, I was at Forbes. I was a director of data and analytics. I did on-chain investigations and looked at the origin of tokens like BNB and others that, their founders, their creators said great things about it. But sometimes what we would find is that there's a backstory of how this project's really took off, and it's not always what they claim. So, anyways, but so with crypto, the thing that I taught me in my Forbes experience was basically that there is the myth, and then there is a reality. I've been in crypto for the last 10 years. I traded crypto when it was really under 10,000. I used a Chinese exchange at the time because that's where the market was happening crypto was at that time. And but here's the thing: since over these last 10 years, for example, what we're seeing is the advent of AI, and with that is the ability to magnify what a single person can do in terms of research. So I've leveraged AI for the last 9 months, built a company called Rigor Rank, and basically it's allowed me to not only cover more ground. Let's say, for example, I want to know what the digital assets regulations in the US or in Brazil or in Mexico or in many other places. I can actually program it to have it go in those directions and fetch the information that I need. And something really useful that I think it's needed in the market today is having a credible voice, something that is not pro crypto or against crypto, but just straight, tell me what the news tell us, analyze the market objectively or as objectively as you can. So I've leveraged AI also to basically fetch not just the rosy stuff, but like key partnerships, for example, but also controversies. So things that escape because there's such a TMI situation, too much information coming at us. Leveraging AI to basically filter a lot of the noise about a particular project or about a particular company is very useful. So that's where I created profiles of 2,500 companies, the who's who of crypto, and basically that's look at each of these companies and projects in an objective way. So that's kind of what we're doing lately.
Perfect. I appreciate that, Javier. Thank you. Just a reminder, if anybody joined this live stream late, there is a link in the chat for our Hollywood event. I think Gav's also got it on screen. Again, we added a pre-show to this event at the Diplomat Beach Resort in Hollywood, Florida. It's on Wednesday, April 8th. It is entirely free for that day. If you want to come listen to some of these speakers, what they have to say about the markets live, who knows what's going to be going on by the time April 8th rolls around. Just on my other screen, I see the new headline that the deadline for the energy plant destruction has been extended to April 6th. So we're getting a little bit of move in the aftermarket here on that news. So in any event, we'd love to see you there. Use that code that's in there and check out the program and join us. I want to pivot to you, Gavin, and actually ask you, what you're seeing amongst, again, you're very wired into the retail investor and trader and what they're saying on these streams and sort of market sentiment. So I want to know what you're hearing out there as a result of what's been obviously a very tough month.
Definitely a tough month. I feel like I'm hearing less panic, though, than I have in the past. I think a lot of the retail investors are remembering times like August a couple years ago. You had April last year, right? And they've seen basically situations that involve a lot of hyperbole and back and forth from Trump, where the market will see a 10, 20% dip and then rip back to the upside when there's a quick change, some type of negotiation, some type of piecing that happens. So I do think that people are getting a little bit less panic than they have in the past, just from what I'm seeing, which is good. People are starting to go through a few different areas. However, if you see another, several percent drop, I could definitely see that escalating. I think people are a little bit less panicked when it's, 10 to 15%, but when all of their AI stocks and all of their different plays, right, that are very high beta start pulling down farther and farther, I could see it causing a little bit of trouble. I think one thing right now that is keeping spirits high is earnings, have been really good when you look at the underlying data and the numbers, especially in a lot of these companies that people are gravitating towards, like an NVIDIA, right? They're just continuing to buoy the market. The numbers look good. They're going up. They're spending. CapEx looks good. It's just this side situation right now with, Iran and oil and other pieces that seems to be coming in. I actually also genuinely think that large majority of retail investors are not oil experts, commodity experts, right? Strait of Hormuz experts. And so this is a little bit removed from their area of expertise to even have the maybe necessary concern about. So for me, I think that people are still moving ahead. Maybe more of my audience is, as Craig referred to them, longer term investors, right? So maybe they're looking at this saying, hey, this isn't something that affects us on the day to day. I think this is true for the stock market. Crypto, slightly more desolate, been down a lot longer, a lot farther than the rest of the stock market has. SPY and QQQ are holding up pretty fantastic until just recently. And I was intrigued to hear. I think it was Javier who said it. He expects another 10-15% drop in that area. That would certainly get people's attention. But yeah, crypto, I think, in a little bit of a tougher area. Certainly, most of the crypto world, I think, has lost a lot of hope. You have, maybe the top 4 or 5 right now in that area that people are still gravitating towards and making their case for and seeing the long-term appreciation for. But that would be just my high-level read on the situation, Mike.
Got it. No, appreciate that. Craig, I want to go to you again. We're talking about crypto and step back a little bit from the price action in the coins and what's happening again in the industry. I mean, there is this fight over the yield issue, but we are seeing again, a company like NASDAQ, NYSE making more deals to try and bring sort of tokenized ETF and stock trading to the world and essentially adopt things that are normal in crypto in the traditional finance space. How do you see that unfolding, from a regulatory, legislative, or industry standpoint, over the next several months?
Well, certainly, President Trump during his campaign, he ran on and appealed to the crypto market and audience, and certainly it was an effective strategy and one of the reasons why he ended up winning. And for the most part, his administration has largely delivered when it comes to providing greater clarity and also more favorable regulatory policies, procedures, and a broader environment for the crypto industry. Obviously, the Clarity Act has been a bit of an issue lately, and Coinbase has been leading the charge to provide a more favorable framework for the industry, particularly when it comes to the stablecoin yield. Obviously, the banks have been pushing back against that. But that really isn't a surprise, considering it certainly impacts their market and ability to provide a service to their customers that is beneficial to them. And obviously, stablecoin yields can challenge that. So we'll see where that heads. I mean, obviously, it's not looking optimistic for the crypto folks when it comes to that. But that's not set in stone yet, and there hasn't been a final decision yet on that. But speaking of Coinbase, they just announced today that they partnered with Better Mortgage to launch crypto-backed home loans, and Fannie Mae is going to accept that. So that's obviously another big win for the industry and a major positive development. Unfortunately, these types of news catalysts don't have an impact on price right now.
Yeah.
But these are, from the Trump administration's perspective, promises made, promises kept when it comes to the industry. Got it.
Well, I'm going to go around the room in just a minute and get maybe some, top actionable ideas or tips for this market. But before I do, the AI topic is of so much interest. Javier, I want to go to you again and just ask, as somebody who's incorporating it into whether it's your trading systems, whether it's your longer term, investing sort of portfolio research and so on, how do you separate, the truth from sort of AI slop or AI, hallucinations and so on? How do you as an investor or trader know that what technology you're building into your system is actually, giving you the right information and is something that you can rely on?
Well, I think right now the answer is in seeing the use cases of the different applications. So if you look at, for example, some of the AI technology that Google is using or Google users are using, it's for silly stuff, to create images and stuff that may or may not have a monetary benefit for anyone. But on the other hand, you have people using Claude, for example, Anthropic, that for building real world kind of businesses. You have the governments trying to leverage that technology as well. So you can see that there's more stickiness to that kind of demand, and there is a certain value indication in terms of so many major names going for the same entity, Anthropic in this case, which is a private company, not yet public. So I think that gives you a sense for what the value is. But there's also niches that could be, a particular AI provider that may be particularly good in a particular segment, and then we would look, for something like that. I think what is also interesting is a combination of AI and robotics, something we'll hear a lot more going forward. I think up until now, many people say, well, I'm going to lose my job to AI, and others don't, and try to plan their career. Let's say, for example, to become a plumber or a roof installer because of that. Less likely that you will lose that battle. But not too far down the road, as China clearly proves, you're going to see machines building buildings, and you're going to see them, laying out wires and cutting things right, just the right measurements, and knowing, all these details through the merging of AI and robotics. And that's where, I think the sense one has to see not AI as a hype, but more like as something that is transforming along with the hardware that comes from robotics into, truly transforming the society. And, what AI doesn't kill you, robotics might, or the union of the two. But rather than being afraid to those trends, I think people should understand them and leverage them, and try to be the first, in the room to understand how to bring the two together, or how to just do AI, because it can take natural language. So if you're an expert at particular, subject matter, you can actually build something really cool, in your area of expertise. So small business owners, they can leverage AI, and we're just at the beginning of that. So I think, there is hype, but I think the market is going to adjust and gravitate towards the more sensible uses of AI.
Well, we've come a long way from the days of iRobot and Will Smith back in whatever that was, 2004, I guess, when it comes to technology. So
early 2000s.
Yeah. In any event, like I said, I always like to keep these things actionable if I can. So I do kind of want to go around the room, and from each of you, get either, your best as you see it, long or short idea here, maybe your most important tip if you don't want to talk about specific names, but just quickly want to remind you, if you're watching this, if you're listening to it on an audio platform, HollywoodFloridaMMS.com, HollywoodFloridaMMS.com has the details on the event where you can see all of these people live. Carley, I guess you've been patient there. You kick things off at the beginning. What do you like? What don't you like? What's maybe a good idea that somebody should be looking into here?
Well, the most popular speculation right now is crude oil, obviously, but the problem is crude oil is very difficult to trade at the moment. If you're trading futures and you place a stop order, you're almost guaranteed to get hit, even if you have a deep stop. And if you're buying options, buying calls, buying puts, they're a fortune. So what we've kind of been guiding our clients is, if you want to participate in crude, if you want to speculate in crude, actually use a market that is related or at least correlated. So for example, if you think crude oil prices are going to roll over and start heading lower because we get some sort of resolution in the Strait of Hormuz, you could buy yen calls. The yen has been beaten down pretty sharply on higher oil prices because Japan is one of the biggest victim of higher energy prices coming out of the Strait. So yen calls are very, very cheap. So instead of spending $5, $6, $7 grand on a crude oil put, you could consider buying a yen call with 2 or 3 months, relatively close to the money, for $600 to $800. So you could do something like that. If you think crude oil is going higher, you might want to do something like buy a call option in a commodity like corn. Corn and wheat have been following crude higher. You're going to save yourself a lot of money and a lot of headache, and probably sleep better at night, but at least you have a foot in the door.
Okay. Good. Appreciate that, Carley. Like the advice. Steve, I'll go back to you. You highlighted a couple of things you saw recently. Is there anything that, maybe again for a slightly long-term holding periods want to look at, either from the longer or short side here?
Yeah, I like what Carley just said, and really it gets back to trade the market in front of you. Crude over the last month is oil energy has been the only sector that's been up. So I look for my sector. So you have to ask, what does my portfolio need? And for most of us, we probably need more bearish setups. And one bearish setup I was looking at beforehand was Walmart, because of just how regular it is. And so it's something that I think is easy to follow the natural swings as it heads lower, and it's not so crazy and volatile that it's something that's a little easier to get in on. And then Javier talked about inverse ETFs. If you're not comfortable buying puts or playing something in the short side, look for those inverse ETFs so that you could trade as a stock. Makes sense. So yeah, you guys are doing great.
All right, thanks, Steve. Darren, again, I guess same question to you, whether there's a longer short setup you like, or if maybe just, some advice you'd really hammer home for somebody trying to trade this market.
Yeah, absolutely. In fact, I'd like to share my screen here.
Sure.
Okay. We talked about crypto, and Craig was mentioning earlier that for the most part that crypto has been following, I believe it was Craig, was following equities. But what I've noticed is that that's true. It's been kind of leading the equities market. But what I thought was interesting, though, is over the past few weeks, we've seen a divergence where basically Bitcoin has been trying to set higher highs and higher lows, while the S&P and NASDAQ have been setting lower highs and lower lows. So we are seeing a bit of short-term divergence. Now, what you're looking at here is actually a weekly chart. So this is not a short-term chart. But this is a very interesting play that I think it has a very good risk reward, in my opinion, and that is the long-term chart of Bitcoin. If you go back, I mean, obviously, if you look at the shorter term, it's a much different picture. But if you're looking at a longer-term potential play, what I like here is what I call the triple convergence of support. So we've got basically three main support areas that are converging right now on Bitcoin. The first one is a 50% Fibonacci retracement. If we go from the lows of December 2022 up to the highs of October last year, we're currently testing right around that 50% retracement, which is obviously a very pivotal level, which I think matters a lot to institutions as well, for kind of a long-term support level. We did undercut it for a couple of months, which is normal, but we also have support converging near that same area, right around the 70,000 mark, which was this prior resistance band here back from March all the way through August of 2024. That was prior highs, so that acted as resistance. And one of the most basic tenets of technical analysis is once a price breaks out above resistance, that prior resistance becomes the new support level. So we could expect that this is a significant support area here. Again, undercut to run the stops is not unusual, but we are trying to hold up right around this 70,000 area. And it could be why we're seeing some short-term bullish divergence. And then the third support level is we've got a long-term trend line that has developed here off the lows of December 2022. Now there's only three anchor points, so it's not a real it's not a real confirmed trend line, but we do have a trend line developing here as well. We've bounced off of twice over the past few months. So obviously, if we look at the shorter term chart, if I go down here to the daily chart, it's a different picture. You can see that Bitcoin was consolidating near the lows for basically almost 2 months. But what I think is interesting here is take a look at this red line here. This is the 50-day moving average. Mm-hmm. And if you take a look, you can see that the 50-day moving average right now has been in play. We popped above it here. A lot going on my chart here. Let me see. Okay. You can see we popped above that level a few weeks ago. And it's been kind of testing, it's been kind of what we have here is a market that's in the short term trying to bounce, but there's a lot of pressure in the broad market. But you can see how it's trying to hold that 50-day MA. Now, obviously, we're not into fighting trends, right? So we are trend traders. But I do think that based upon what the charts are showing me, that we could see a short to intermediate term bounce in crypto. Up to about the 84,000 area would be the next target on the short-term basis. And what I like about this really is just the risk reward of it, because even if for example, if somebody were to get in right around here and set a tight stop, right, tight stop just below the lows of about a month ago, or even if you want to go a little bit lower and go below the swing lows, all the way back on the weekly chart. I mean, you're looking at basically a 3 or 4 to 1 risk reward ratio up until we see major resistance. So I think that's a pretty solid play longer term. So that's what I'm keeping an eye on.
Okay. Great. Thanks, Darren. Craig or Javier, anything that you really like from, I guess, the buy side here? I know, both, you talked about inverse ETFs. You talked about some of the weakness we've had in crypto for the last 6 months. But I'm wondering, for maybe the long-term investors that are listening to this, is there anything particularly attractive that you think, like Darren said, we could be at support or could be a nice play to add on the cheap here?
Yeah, I think the BITI and SBIT are basically the 1x and the 2x short Bitcoin ETFs would be vehicles in which I would enter a relatively small tactical kind of trade if you want to be active trading, just for psychology's sake, not necessarily huge conviction. But I do think that if somebody were to ask me, like you are today, is it more likely to go down than up? I would say yes, more likely to be, because of the wider market, that there's a lot of airspace, a lot of gravity pulling it down, based on macro fundamentals. So I think given that scenario, is even if, like Deron mentions, there is a potential attractive risk reward on those three convergences that he mentioned. I think even so, the gravity pull from the wider market, should it, continue to decrease, it would be tough for any risk asset like Bitcoin to, to break out of that gravity pull. So I think for that reason alone, and the lack of certainty in terms of oil prices and gold, I think more likely than not, things are heading south. But you should control, like also Deron said, the trade size. It should be maybe 1-2% of your account. Having a good sense of stop losses and and like Steve mentioned, an attractive risk reward, in place.
Fair enough. Craig, anything you want to add to that at all, or?
Yeah. So Darren, actually, it's pretty interesting. You brought up the Bitcoin chart and your short-term price targets, and I've been seeing the same thing. So I expect over the coming weeks, Bitcoin to get into that 80K to 85K range. And then obviously some of the other tokens will see an even bigger upside in that short-term period. However, over the course of the year, I'm still pretty bearish on it and the broader markets. And, if you look at Bitcoin's monthly chart dating back to 2017, momentum has been plummeting. And I don't really see a recovery until it hits the lower boundary of this broadening wedge pattern until around 40K. So that actually lines up, with the typical bear market drawdowns of 80+% that we've seen in other crypto winners. So, short-term relief, I'd be looking, for these swing traders, I'd be looking to sell into these rallies for sure, both on the broader stock market and when it comes to the crypto markets.
Yeah. Thanks, Craig. Gav, we're getting towards the tail end of the time, and I want to give each person a little chance to chat about what they're going to talk about in Hollywood. But just to you, anything that looks really interesting to you at this point, either long or short?
Definitely. I'm still looking at a few long positions, three that I just really like right here. Really like Netflix. The setup on Netflix looks great to me. They had a huge sell-off that started back in July of 2025. They went down roughly about 45%. They've bounced back. They have really strong numbers. What I love here about Netflix is that they are adding very high quality content. They had MLB opening day baseball, was live watching it on there. They had the Alex Honnold. They've added different fights, other pieces like that. So they're really pulling in a user base of people to watch these things, and they're only going to be adding more of these. It seems like they've really understood the direction to be going. They cut out of that merger, which got them I think it was $2.5 billion fee that was paid to them. They now don't have to worry about all the debt that they were going to take on to move forward with that. And so I really like Netflix here, in a great place. I actually bought more Netflix this morning, and out of many things in my portfolio that are red, they are actually green. So I'm a fan of that in that area. Also, still very interested in the power thematic, which is getting hit a little bit here today, but power and energy, names like Quantra and others like those are really very interesting to me. I just look at POW, which is POW. That's an ETF for electrification supercycle. That's held up super well this year in comparison to, a lot of names which are down 10, 12 plus percent. To me, that's an interesting area, and it's up 22.5%, that specific ETF, but that whole industry has held up really nice. You've got Powell Industries, Eaton, Quanta, Hubble. Names like that are still really appealing to me, especially some of the stuff which is international as well that could fit into there, like an SK Hynix and pieces like that. And then the only other thing that I'd mention, and I don't know if I'm touching it just yet, but Meta to me is very appealing. Meta had a huge drawdown today. They're down 7.71%. That's a massive amount of their market cap. They're at their lowest point since April of 2025. That drawed in April. They went all the way down to 473. They're at 549 right now. So if this keeps going down and getting closer to those areas, that's one that's fascinating to me.
Yeah, that's the whole they're turning into big tobacco kind of trade, right? They're gonna get sued into next century. Yeah. Anyways, and you never know. Like I said, is it priced in or is it not? That's sometimes you got to step up and buy. I hear you. With the time that we have left, I mean, Carley, I'm going to go to you again. You kind of kicked us off here. Your topic is officially, will crude oil and gold volatility bleed into other assets? I think that we kind of know the answer to that question, but I just want to maybe see if you can share a little bit more. Somebody comes to your presentation in Hollywood. What are they going to pick up? What are a couple pointers they'll have there?
Yeah, so obviously assets are reacting to crude oil, so that statement is true. But what I mean by that is I think that crude oil is breaking things. Anytime that crude oil increases this far, this fast, stock markets tends to struggle, and we actually generally get recessions. After the 2022 oil spike, we changed the definition of recession, so technically we didn't go into recession, but we did. So when you see crude oil spiking and then you see the dollar spiking higher, which most people don't have their eye on because they're too worried about crude oil and gold and all these other things, that's not an environment for growth and prosperity. So I really worry that we've got quite a bit more selling in the indices. I know under the surface there's been a lot of selling, but the S&P actually has held up very well. And I think that at some point, something's got to give with the S&P, and I think we kind of reprice quite a bit lower.
Got it. Thank you for that. Steve, I'm going to go to you. You've got the interesting title, Covered Calls on Steroids. What do we need to know about what you can do with covered calls in this market?
Well, I cut my teeth on covered calls back in 2001, a little bit of time ago. Silver anniversary of doing that. But to do that on steroids, I want to use leverage and also be able to go in either direction. And so the idea of cash flowing and lowering your cost basis every time you bring in a credit, especially as the volatility kicks up and the options get more expensive, sell into that a little bit. That's number one. Number two, the other thing I'm doing is that mean reversion technique. It's like a 4-day trade, like a put or a call trade. You can do it in about 4 days because markets don't just move in a straight line. They usually take these little dips and swings. So this is how you could buy dips or sell rallies in a bearish environment.
Got it. Darren, you're talking about why smart traders break their rules. Why do they do that then?
That's a good question. I think a lot of people, especially when they're new, when I was a new trader, like almost 30 years ago, I really underestimated the importance of understanding trading psychology and understanding yourself. And I learned through the School of Hard Knocks. I lost a lot of money in the beginning because I thought that if I just learned technical analysis, I just learned the chart patterns, that's all I needed to know, right? And I found out the hard way that that's not true. So we have kind of a different approach when we mentor traders. We focus on a psychology first approach, basically learning to master yourself so that your inner me is not your enemy. That's what we try to avoid. And basically, one of the reasons, to answer your question, the reason that smart traders make bad mistakes is they let their emotions control them. And that happens because oftentimes they don't have a rule-based strategy. Right. So when you don't have a rule-based strategy, it's very easy to let your emotions control you because you're kind of, just winging it as you go. But if you're following a rule-based strategy, you have a trading plan. For example, position sizing, we mentioned earlier, that's really key. We're going to be talking about that in Hollywood, how a fixed position sizing formula can actually, how it's correlated to the 4 deadly emotions, fear, greed, hope, and regret, and how just keeping proper position sizing enables you to follow your plan and to trade what you see, not what you think. So that's what we're going to be talking about there. And by the way, I forgot to mention, if anybody wanted to see that analysis I did on Bitcoin a little in more detail, I just did a video on it on our YouTube channel, if anybody wants to check that out.
Perfect.
But looking forward to meeting everybody in Hollywood. Thank you.
Appreciate it, Darren. I know we've kind of touched on crypto strategies from both of you, Javier and Craig. I know the other part of our panel is going to be focused on AI strategies. Anything very briefly you want to add that maybe you're going to be talking about on the AI front there? Maybe with you first, Javier?
Yeah, sure. One of the reasons why I'm bullish long-term over, in crypto in general and AI is that institutions are coming on board, evidenced by the recent announcement by NASDAQ and by DTCC as well, to tokenize securities and making them available 24/7. for also the decision of MasterCard, for example, to buy a stablecoin technology infrastructure firm, and partnerships between Swift and Chainlink, and to give an example. So there's a lot of convergence between traditional finance and digital assets taking place. It's selective, but that's where you need to do your due diligence, and you need to know, is it hype or is it real? Is there actual key partnerships? There's been some vetting of the technology. There is a use case for it. And that's, the fundamental research that is needed alongside the technical analysis that we often hear, and the pundits that are very loud, So I think there is reason to be optimistic. After all this noise that we see right now, is a crypto bear market. But having said that, the institutions are coming to play in their field. That is a sign of growth to come. And the fact that, in a way, NASDAQ and other exchanges, traditional regulated exchanges are going that way. I think it's a sign that, the market is, the technology is getting adopted. And so we're going to see this convergence of tokenization, real world assets tokenized, not just stocks, possibly other real estate assets as well, and commodities, and we see convergence of derivatives markets on crypto, as we see the that has been primarily offshore, that is getting brought in onshore as well through the CME and other efforts. And we see the traditional crypto that is still high risk, and then the meme coins that are just trading trends. So it's a very interesting convergence that we're experiencing, and it's it's not susceptible to the current highs and lows of the market. So that's why I'm still optimistic on the market in general.
Anything very briefly you'd want to add, Craig, as just sort of
Yeah, Mike. So a couple of weeks ago, the Future Proof Conference was held here in Miami, and it brought together thousands of folks in the investment management industry. And I had a chance to briefly interview Tom Lee of Fundstrat and Bitmine. He's obviously the chairman of Bitmine, which is the second largest digital asset treasury company after Michael Saylor's strategy. And I said, look, Tom, obviously this is a pretty nasty bear market. How do you see things playing out? And he's like, look, this is my third crypto winter since 2017. And I see it playing out the same way. Sentiment turns negative and people will rage quit. However, the best money is made in bear markets if you're a long-term investor. So I think 2026 is going to be a rough year, but looking past that, I'm definitely bullish on Bitcoin and the broader stock market.
Perfect. Thank you so much, Craig. To everybody who's watching, if you tuned in late, as a reminder, you're going to have a chance to see all of these speakers asking your questions live at our event that's coming right around the corner. It's the 2026 Money Show Masters Symposium in Hollywood, Florida. Gav dropped the link into the chat. You might have it on screen. It's at the Diplomat Beach Resort. The main event, April 9th to 11th. And the pre-show, which is 100% free to attend to check things out, is Wednesday, April 8th, Hollywood, Florida, MMS.com. Everybody, Carley, Craig, Darren, Javier, Steve, and Gav, thank you so much. I really appreciate you taking the time out. And everybody who watched, thank you for joining us as well.
Thank you, Mike.
Thanks, Mike, for hosting us. Thank you, everyone, for tuning in. Appreciate everyone that watched. This will turn into a recording as soon as we close it out, so people can rewatch from the beginning if there's anything that you want to check out. Looking forward to the next one of these shows. Take care, everybody. Have a great rest of your Thursday. We'll see you on the other side.